Hello, I'm James, you're watching Accounting Stuff, and today we're going to cover the cash and accrual methods of accounting. This is a special compilation video that I've sliced into two halves. First, we'll look at the cash method of accounting. Then, you guessed it, I'll break down the accrual method. Make sure you watch this one through to the end to understand the key differences between the two. So, what is the cash method of accounting? The cash basis of accounting is a method of recording financial transactions. Under this method, transactions are only recorded once cash changes hands. We record revenue only when cash is received, and we record expenses only when cash is paid out. Let me elaborate on this with a simple example. Imagine you've got a baking business and a customer places an order for a birthday cake. The ingredients for this cake cost you $10 to buy, and you are selling it at a 150% markup on cost, so the customer pays you $25. You've got two transactions to record. First, you need to record the expense, which in this case is the cost of buying the ingredients for the cake. You debit your expenses by $10 to increase them, and you credit your cash by $10 to reduce your cash balance. You then need to recognize your revenue, which is the $25 that the customer pays you. You debit your cash by $25 to increase it, and you credit your revenue by $25 to increase it as well. Now, I want you to consider two scenarios. The first is that you buy the ingredients for your cake, you bake it, and you sell it all the same day on the 25th of October. The customer pays you in cash. Under the cash basis of accounting, transactions are recorded when money changes hands. So in this case, you record your expense and your revenue on the same day, the 25th of October. The second scenario is the same as the first, except this time the customer pays on account. Your business has 7-day payment terms, so you receive the cash a week after you baked and handed over the cake to the customer. Under the cash basis of accounting, you record your expense the day that you bought the ingredients for your cake, and you recognize your revenue the following week on the 1st of November, because that's when you received the cash from the customer. So, what are the pros of using this method? For one, it's a great way to record transactions for small businesses that deal and operate mainly in cash. It's simple and easy to understand, so your business doesn't necessarily need to hire an accountant or someone that understands more complex accounting methods. That makes it cheap to maintain, and you might be able to get away without paying for more pricey accounting software. And finally, many countries accept this method of accounting for tax purposes, so long as your earnings are below a certain threshold. So this could be a viable option for you. Now you might be thinking, wow, this sounds amazing. Why doesn't everyone do it? Well, in reality, most businesses are much too complex to use this method of accounting. When you cash account, you don't have an accurate way of recording your profits, so there can be huge fluctuations in your results. This is caused by recording income and expenses in separate accounting periods. If we go back to that second scenario, we can see that we recorded the expense in October and the revenue in November. So the October accounting period would show a loss of $10, and the November accounting period would show a profit of $25. It would make much more sense to show a profit of $15 in October, because that's when the work was done. In addition to this, you have no way of knowing your financial position because you aren't recording your payables and receivables. Finally, and this can be a clincher, the cash basis of accounting isn't allowed under GAAP or IFRS. So if you follow either of these principles or standards, then no dice. So the cash basis of accounting can be a great way to record transactions if you've got a small business that relies solely on cash. However, if your business has payables and receivables, this method probably won't work well for you because timing differences between cash in and cash out mean that you don't have a reliable way of recording your profit. If that's you, then you'll need to use the accruals basis of accounting instead to match up those revenues and expenses. I'll take you through this method in the next episode of Accounting Stuff. So under the cash method, revenue is recognized when cash is received and expenses are recorded when cash is paid out. Now, I've got something special for you. Here's the second edition of my all-in-one accounting cheat sheet bundle. Updated in full color with new layouts, topics and hyperlinks that allow you to jump between pages in a matter of seconds, I've designed these to help you learn accounting faster. And yes, of course, it covers the cash and accrual methods of accounting. You can grab yourself a copy today at accountingstuff.com/shop or follow the link in the description. Okay, it's time for part 2. What is the accrual method of accounting and why do we need it?
With a cash basis, you record your revenue once you receive the cash, and you record your expenses when you pay that cash back out. It's a great way to do your books, and it's simple. And that's the reason why it's an approach used by many small businesses and individuals for personal finance. However, there is one big problem with this accounting method. It can be really hard to work out your business's profitability, particularly when you want to work out how much profit you made for one particular point in time, like 1 month of the year, for instance. And that's because of the timing differences between when you recognize your revenue and expenses. I'll give you an example of this in a moment. The accruals basis of accounting solves this issue. Revenue is recognized as it's earned, and expenses are recorded as they are incurred. It's a way of recording the substance of transactions, and that makes it a much easier way to record the performance of your business over a specific period of time. Let me explain. Let's go back to that example of a baking business selling a cake that we discussed in the previous video. The ingredients of that cake cost us $10 to buy, and we sold it for $25. That leaves us with a profit of $15. Now, let's imagine a scenario where we sell a cake to a customer on the 25th of October. The customer has 7-day payment terms, so we don't receive the cash until the 1st of November. Under the cash basis of accounting, the revenue would be recognized on the 1st of November because that's when we receive the cash. However, under the accruals basis of accounting, the revenue would be recognized on the 25th of October because that's when the substance of the transaction occurred. That's when we physically handed over the cake to the customer. Now, let's also imagine that we baked that cake using ingredients that we purchased a month ago in September. Under the cash basis of accounting, we would have recorded the expense in September because that's when we paid the cash for the ingredients. However, using the accruals basis of accounting, we would instead record that expense in October because that's when we sold the cake. You can see that under the cash basis of accounting, we recorded a loss of $10 in September and a profit of $25 in November. This timing difference that you can see here could cause us a real headache if we wanted to look back in time and review our performance in October because we wouldn't see any profit there. It might not seem that complicated for this one example, but imagine that we'd sold 100 cakes and they all had timing differences just like this one. It would be a nightmare to work out our profitability for a particular period in time because we didn't record the substance of the transactions as they were incurred. However, the accruals basis of accounting neatly solves this issue for us. We record both the revenue and expense in October, so we can see the profit of $15 in October, just like you'd expect. Our revenues and expenses are aligned with each other in the same accounting period because in the accruals basis of accounting, we apply the matching principle. The matching principle simply states that revenue and all expenses incurred in order to generate that revenue need to be recognized in the same accounting period. This is a key differentiator between the cash and accrual methods of accounting. The matching principle makes it easier for us to objectively analyze results because you can accurately measure your profit over time. Now that we've clarified the accruals basis of accounting, let's run through some of its pros and cons. First of all, like I just said, it applies the matching principle so a business's profitability can be accurately measured for specific time periods. It also measures accounts receivable and payable so you can build a picture of your financial position. And it's accepted under GAAP and IFRS, so it's possible to produce financial statements under these principles and standards. On the other hand, however, the accruals basis of accounting doesn't explicitly track cash flow, so this needs to be calculated separately using the direct or indirect method. It's also more complicated than the cash method of accounting because you have to make estimates and assumptions. This can be unsuitable for small businesses, hence why many of them choose to adopt the cash method of accounting instead.
So under the accrual method, revenue is recognized as it's earned and expenses are recorded as they are incurred, regardless of when cash changes hands. Remember to like and subscribe if you found this useful. I'll drop a link to my all-in-one accounting cheat sheet bundle here. And if you'd like to learn more about accounting, then why not give this video a watch next? I'll see you there.